Analysis now on this. I'm joined by economists and macro strategists at Matrix Fund Managers, Carmen Nel, as well as South Africa, United Business Confederation President George Sibulela. But Carmen, let's begin with you. Good evening, and thank you very much for your time. A disappointing third quarter with a contraction of 1.5%. Is this something that would have been expected, and therefore something that could possibly alarm the markets in any way?
Yes, good evening. I think initially, sort of at a headline level, it was disappointing, but I think there are two things to note. The first thing is that the 1.5% contraction was not nearly as severe as what we thought it would be when we were sort of in the midst of the social unrest. Estimates then were sort of closer to 3%. And then the second point is that a lot of the weakness actually came from the agricultural sector, which we know is extremely volatile. Whereas if you look at the more detailed breakdown of GDP in the third quarter, you can at least attribute the weakness very much either to the lockdown or then the social unrest. So I don't think it was sort of enough to shock the markets, and sort of looking at what the Rand did today, as well as bond yields and equities, it really didn't have a major impact on financial markets.
The fact that, it's the primary sector really that is largely being affected here if you look at this pattern, but also you're seeing there is some movement in the secondary as well as the tertiary sector. Is this something that will be short-lived? Of course, we are now dealing with the Omicron variant and what that will present as far as the government allowing for economic activity to continue.
Well, certainly I would be surprised at this stage if the fourth quarter also showed a GDP contraction. If you look at the Purchasing Managers Index for October as well as in November, that's been on a steady rise. It actually reached quite a high level of 57 in November, so that suggests that at least manufacturing, which is in the tertiary sector, has or is busy rebounding. Business confidence remained depressed at 43, but then if you look at, for example, Google mobility data or even tax revenues, mobility has largely normalized and tax revenues are holding up. Those point to a rebound in the fourth quarter, which suggests that the third quarter weakness was temporary. That said, I think we should be cognizant of the longer-term threats that the social unrest has for sort of a fixed investment and then potential GDP growth in the longer run, and that remains highly uncertain.
On the demand side, trade really struggling there because household consumption seemingly having decreased. Reflection really of what families and consumers are feeling out there.
Yes, certainly. If you look at the breakdown, it was very much sort of a defensive household sector in the third quarter. So spending on health expanded and then sort of ticked up slightly if you look at education. But other than that, there was a contraction. I think, one, it does reflect the lockdown, so, constraint on what households could do during the third quarter. Income growth was actually not that bad in the third quarter. So it does suggest that there was a lot of sort of pent-up demand which supported first half GDP growth, via household consumption expenditure, and sort of the third quarter was now coming off a high base. And maybe, the social unrest did create some uncertainty and therefore sort of caused households to become a bit more conservative, opting to save whether they were able rather than to spend on sort of discretionary items that they want rather than what they need.
Yeah. Will this in any way affect our monetary policy, and will the MPC likely raise the rates or maybe stay put?
That's a key question. So we know they've started the gradual normalization process at the November MPC meeting. I certainly think this data, the SARB would think this data was not quite a one-off, but more of a transient or temporary hit to GDP, and that the recovery has now resumed in the fourth quarter. That doesn't mean there aren't other risks, as you note, the Omicron variant and potential restrictions there. But I think the Reserve Bank's a lot more focused on upside risk to inflation at this stage. I think there's some concern creeping in about currency weakness. and they're looking at what's happening globally with regard to the Federal Reserve in the U.S., set to taper or currently tapering, potentially hiking by the middle of next year. So I think they're probably going to hike once or twice again, and not really look at backward-looking GDP data to determine what should be forward-looking monetary policy.
As far as, of course, the position that we have taken as a country, particularly here, I'm talking Treasury in their medium-term budget statement. Should anything change there in their attitude and their posture?
Well, I think they face a very difficult balancing act. I think, they tried to hold the line in terms of wage growth. They did not commit to expanding grants in the medium-term budget policy statement. But if you look at the unemployment data that was released for the third quarter, that was quite weak. We've still got a meaningful jobs gap if we compare to where we are now versus pre-COVID levels. So I think there's going to be a lot of pressure on the Treasury to do something around a grant or support for the work seekers come the main budget in February. So I think they are going to face that spending pressure. For now, they've got a bit of a buffer on the revenue side, but we know that this terms of trade boost from high commodity prices is temporary, and we shouldn't bank on that being sustained.
Carmen Nel, appreciate your time. Thank you very much for coming through. Economist and macro strategist there. Carmen Nel helping us make sense of those numbers.